Imagine putting all your money in one single investment, and then it loses value overnight. Scary, right? That's where diversification comes in. Today, we're breaking down why spreading your money across different investments is one of the smartest strategies in investing. We'll show how diversification reduces risk, helps your portfolio grow steadily, and protects you from unexpected market swings. By the end of this video, you'll see why diversification isn't just smart. It's essential for anyone serious about growing their money safely. Today, we will talk about why diversification is the key to smart investing. So before we start, make sure to hit the like button and subscribe to my channel. 1. What diversification means. Diversification is the practice of spreading your investments across different types of assets, industries, and regions to reduce risk. Instead of putting all your money into one stock or asset class, you allocate it across multiple investments, so poor performance in one area can be offset by gains in another. The main goal is to protect your portfolio from volatility and unexpected losses. Diversification does not guarantee profits, but it helps manage risk and smooth out returns over time. For beginners, understanding diversification is critical because it transforms investing from a risky gamble into a more disciplined, strategic process. Diversified portfolios can include stocks, bonds, ETFs, real estate, and even commodities. By holding a mix of assets with varying risk and return profiles, investors can pursue growth while minimizing the impact of negative events on their overall wealth. Proper diversification balances risk and reward, making it a cornerstone of smart investing. 2. Why diversification matters. Markets are unpredictable. Even strong-performing stocks can suddenly decline due to company-specific problems, economic downturns, or global events. Diversification protects investors from these risks by spreading exposure across multiple investments. For example, if technology stocks drop but consumer staples rise, a diversified portfolio balances the loss. Without diversification, a single poor-performing investment could significantly damage your portfolio. Beyond protection, diversification also enables consistent growth over time. By combining assets with different risk and return characteristics, you can reduce volatility while capturing potential upside. This is especially important for beginners who may not yet understand market cycles or risk management. Diversification allows new investors to participate in the market safely, reducing anxiety and improving long-term outcomes. It transforms investing from a high-stakes gamble into a controlled, strategic approach that balances opportunity and protection. 3. Types of diversification. Diversification can happen in several ways. The first is asset diversification, spreading investments across stocks, bonds, real estate, and other assets. The second is sector diversification, investing in multiple industries like technology, healthcare, energy, and finance. Geographic diversification spreads risk across countries or regions, protecting against economic or political instability in one area. Even within a single asset type, like stocks, diversifying across multiple companies reduces the impact of a single company's poor performance. Beginners can achieve diversification using ETFs or mutual funds, which contain multiple assets in one investment. Proper diversification combines these strategies to balance risk and growth potential. Understanding types of diversification helps investors design portfolios that are resilient to market fluctuations, global events, and sector-specific downturns while maximizing long-term wealth-building potential. 4. Reducing risk through diversification. Diversification primarily reduces risk, especially unsystematic risk, which is specific to individual companies or sectors. For instance, a company scandal or product failure might sink a single stock, but a diversified portfolio minimizes the impact. Systematic risk, like economic recessions, cannot be fully avoided, but diversification still helps balance overall performance. By spreading investments, losses in one area are often offset by gains or stability in others. This approach reduces emotional stress, as investors are less likely to panic during market dips. For beginners, understanding how diversification reduces risk encourages patience and disciplined investing. Instead of chasing short-term returns or concentrating on a single hot stock, diversified portfolios provide steady growth, making investing safer and more sustainable over the long term. 5. Diversification and long-term growth. Diversification supports long-term growth by balancing high-risk, high-reward investments with stable, lower-risk options. Stocks can provide significant growth, while bonds or dividend-paying assets offer income and stability. This mix allows the portfolio to capture gains while minimizing potential setbacks. For beginners, diversified portfolios often outperform concentrated high-risk strategies over time because they can weather market volatility. Long-term growth depends not just on returns but also on avoiding major losses that can erode wealth. Diversification allows investors to stay invested during downturns, take advantage of compounding, and steadily accumulate wealth. Understanding the link between diversification and long-term growth is essential for developing a realistic, disciplined investing approach that prioritizes both safety and opportunity. 6. Diversification across asset classes. Investing across multiple asset classes is a cornerstone of diversification. Stocks, bonds, real estate, commodities, and cash alternatives all behave differently under various market conditions. Stocks offer growth, but are volatile. Bonds provide steady income and stability. Real estate can generate rental income and long-term appreciation. Commodities like gold or oil can hedge against inflation. Cash or cash equivalents provide liquidity and security. By allocating money across these classes, investors reduce dependence on a single type of investment. Beginners can start with broad ETFs, or mutual funds representing multiple asset classes. Understanding how different assets interact helps design a portfolio resilient to market swings, inflation, and economic uncertainty, increasing the likelihood of steady, long-term wealth creation. 7. Diversification within asset classes. Even within a single asset class, diversification matters. For stocks, this means holding companies in different sectors, sizes, and geographies. For bonds, it includes varying maturity dates, credit ratings, and issuers. Within real estate, diversification could mean different property types or locations. Beginners often overlook this layer, focusing on a few favorite companies or assets, which increases risk. Diversification within classes spreads exposure, reducing vulnerability to individual failures or sector-specific downturns. It also provides more consistent returns over time. Understanding this nuance is critical for beginners aiming to create a balanced, resilient portfolio that captures growth while minimizing the impact of isolated losses or market disruptions. 8. Tools for easy diversification. ETFs and mutual funds are popular tools for beginners to achieve diversification quickly. An ETF tracking a broad index like the S&P 500 provides exposure to hundreds of companies in one purchase. Mutual funds pool money from multiple investors to invest across stocks, bonds, or other assets. Robo-advisors also automate diversification, creating portfolios aligned with goals, risk tolerance, and time horizons. These tools reduce the complexity and effort of managing multiple individual investments while maintaining balanced exposure. Beginners can use these solutions to get started confidently without worrying about picking individual stocks or monitoring multiple assets constantly. Tools like ETFs and mutual funds make diversification accessible, cost-effective, and practical for investors at any experience level. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.